which is you juxtaposed IndyMac and WAMU's failures in the beginning, and the value of having that unsubordinated debt kind of making a huge difference. So imagine that your speech in Brookings 2019, that requirement had been put in place, the requirement that's coming from the three regulators for the unsecured debt. Would that have been enough for SVB to avoid needing the systemic risk resolution?
So if I may say, you're raising a hypothetical, but I think without a doubt it would have helped, and I sort of tried to outline that. You can't say with certainty it would have avoided the failure. I think had they had a substantial amount of unsecured debt, that would have been reassuring to uninsured depositors and might have influenced their behavior. And even if it had not been sufficient to avoid the run and the bank still failed, having that unsecured debt as a buffer would have mitigated the loss to the deposit insurance fund and might have put us in a position to avoid exercising a systemic risk exception. So whether it could have avoided the failure altogether, we can't say. I think there's a chance of that. And even if it wouldn't have, it could have been quite beneficial in mitigating the impact of the failure. So the common sense of extending such a requirement to regional banks, to me, is pretty persuasive.
So yeah, to be clear, I think the failure was a good thing in the sense that that bank deserved to fail. It was a poorly managed institution with an unstable funding base and a bad business model. Stopping bank failure is not, speaking just for myself, is not my goal. Stopping the use of systemic risk exception is very different, and I take it that it is your belief that the imposition of this loss-absorbing capital will have impacts on both, but particularly on stopping the need for systemic risk exception authority and creating enough buffer above where the taxpayer and the FDIC fund lay.
Yeah, I think that's true, but if I may say, sitting where I sat, the possibility of avoiding the failure and the disruption to the system, if that were, an alternative scenario, that would have been of great value to the system, to the financial system, and to the economy. So if I may say, Aaron, I don't discount that potential benefit as well.
All right. Speaking of benefits, there's going to be a lot of focus on TLAC. It was the first question. It's been kicking around for a long time. It's had a lot of area, and it's, as you said, you already had an ANPR out about it. Now you're moving advanced notice of public rulemaking. Now you're moving to a notice of public rulemaking, and in essence, the rule. The second part has to do with the resolution plans and the upcoming rule on that. And it's easy to think of those separate and apart and not together. What do you think the combinatory value is of having both of these together as opposed to just thinking, okay, now we have loss-absorbing debt, now we have resolution plans, this adds that. In economics, we sometimes look for interactive variables in our analysis. What are the combinatory effects?
Look, from the standpoint of the agency actually responsible for executing the resolution in an orderly way, having the loss-absorbing resource, in a sense, is a threshold, but you can't overstate the value of having the information and the strategic thought and the optionality prepared ahead of time that can be used in deploying the additional loss-absorbing capability, which is why we place a lot of importance on the two going together, acting on the long-term debt requirement and significantly strengthening the resolution plan requirement for these regional banks as really going hand in glove, and particularly giving us as the agency the information and the strategic thinking well ahead of time that would just put us in a much stronger position. And I think taking together, it's just common sense, a much, much stronger foundation for dealing with the possible failure of one of these institutions. And look, if we, in addition, and we have already proposed it, requiring capital against these unrealized losses. Let me put it this way, hypothetically, just to be clear. But if we had had a buffer of unsecured debt for Silicon Valley Bank, if we had had a robust resolution plan, and if Silicon Valley Bank had been required to hold capital ahead of those unrealized losses, you know, it's hypothetical, but we could have had a different scenario. I mean, I think that's plausible. I think that's plausible, and given the costs and risks associated with the potential failure of institutions of this size, you know, the policy case for having these requirements, to me, as I say, is really pretty compelling.